Hey everyone, this is Caleb Franzen with Cubic Analytics. It's Friday, July 1st. Welcome to the second half of 2022. I think everyone's hoping it's going to be better than the first half, but there's obviously no promises. We got to be flexible with dynamic data as it continues to come in, which is essentially going to be kind of the point of today's video, which is basically to review and discuss some of the different dynamics that I'm seeing in the bond market today, continuing with the analysis that I had posted and published last weekend in my newsletter, cubicanalytics.substack.com. And in last week's newsletter, I would say the main focus of the dynamics that I was pointing out was the substantial decline in yields and commodity prices, while bonds and stocks both rallied substantially to the upside, particularly after the Federal Reserve's 0.75% rate hike on July 15th. And at that point in time, bonds were essentially celebrating, which was leading me to think that smart money, aka bond and fixed income investors, were starting to price in a peak in inflation, or at the very least, believing that the Federal Reserve's new path of projected monetary policy might be effective in combating 40-year highs in inflation. And so I had kind of talked about how we were possibly at this inflection point in the market because of the signal that we were seeing in bonds. However, that inflection point was very important because it was essentially saying, great, risk assets and bonds have the opportunity to rise from here, or that inflation hadn't peaked and that bonds and stocks were going to continue to get slaughtered in this environment, and that bond investors were wrong. Hence why I was saying we were at this important inflection point. And I think what we've started to see this week, and something that I've been posting and talking a lot about on Twitter, is that we're actually starting to see a slightly different dynamic, which is that yields are falling and the dollar, well, let me say it this way, is that yields are falling, which is indicative of higher demand for bonds. So we're seeing bonds across the maturity spectrum rally substantially over the course of this last week. However, the dollar is also rising substantially in that environment where yields are falling, and risk assets are having a very difficult time catching a bid. And if you've been paying attention to this channel or different analysis that I post either on Twitter or on Substack, you'll know that yields and asset prices have an inverse relationship, all else being equal. So when we see yields plummet, but risk assets unable to catch a bid, it's very worrisome and indicative of a risk-off environment. And that is essentially what we're seeing in this market, which is confirmed by a substantial rise in the US dollar over the course of this past week, even though yields have plummeted. And typically we see a direct relationship between yields and the dollar, but this week we're seeing an inverse relationship. We're seeing yields plummet and the dollar rise substantially. And so I wanted to discuss this because it's actually showing us a different inflection point than I had initially assumed, right? Which is why it's so important to stay flexible with a dynamic market, because investor appetite can shift on a dime. New data can come in and change market dynamics on a dime. And so I think what we might be starting to see actually is a market that's becoming more preoccupied with lower growth and outright economic recession instead of the inflation dynamics. So this is very important. And so I wanted to go over a couple of charts really quick to kind of confirm some of this sentiment. So what we're looking at right here on the chart is the 10-year Treasury yield with weekly candles basically going back to Q4 2017, but I mean, that's basically irrelevant. We can just start here in 2018. And we can see that during the Fed's last tightening cycle, yields had a lot of tailwinds to rise in this environment. Boom, they were accelerating higher. And they only peaked at the end of 2018, pretty much in Q3 or Q4 of 2018, when the market started to get a sense that the Fed might be shifting or reversing course in their policy. Sure enough, in December of 2018, the Federal Reserve paused their 0.25% interest rate hikes and basically signaled to the market that they were back to accommodate financial markets. And so yields plummeted in that environment, which was then exacerbated by the COVID crisis, but have been roaring back higher. Now, one thing in particular that I want to call out is the absolute brutal decline in yields we've seen this week for 10-year treasuries. If we just look relative to last week's close to today, they're down 10.45%. That's a substantial decline. if we look at basically the peak from the Fed's policy decision week to now, yields are down 19.7%. That's a substantial decline in yields, which is again, making us debate whether or not is the bond market no longer concerned with inflation? Is the bond market expecting that inflation has peaked? Or is the bond market purely pricing in lower growth, which is expected to cause inflation to roll over at some point, right? Because typically we can look at recessionary periods and see that most of the time, I think it's like 80 or 90% of the time, inflation falls during that recessionary period. Now we can point to certain levels or times in history, such as 1974 and 75, where inflation continued to run rampant during the recession, peaked towards the tail end of the recession, and then proceeded to roll over. But still, I don't want to say common, but basically we could say history tells us that recessions tend to push inflationary pressures lower. And so that might be what look at this. Today, 10-year treasury yields are down 6%. I can't speak today, sorry. If we look at 5-year treasury yields, down 7% in today's session. It looks like we have an official failed breakout here over those 2018 highs, unable to sustain an extension above that level. And now, here's a key thing, is that let's switch over to daily candles here. We may actually be at threat of ending this process of higher lows. As we know, one of the key ways to identify a bullish trend is the production of higher highs and higher lows, which essentially creates this stair-step behavior higher. And we can see that yields have been following that stair-step behavior higher. We go through extensions, consolidations, breakouts, consolidations, breakouts, extensions, rinse and repeat, right? And so what we're seeing now here is a potential threat to that trend, at least on a shorter term basis, going back to mid-April, where we might actually be starting to make a lower low or breaking below this support trend line here on a shorter time scale. Now you could maybe nitpick and point to some of these other trend lines, right? We never know which one is exactly in play, so it's going to be interesting to see how this plays out. However, 5-year treasury yields down 22.6% from the peak in mid-June. So it's literally been 2 weeks and they've fallen 19.6, 19.7%. That's a substantial decline. If we look at actual bond prices, wow, this is actually really interesting. I haven't pulled this chart up yet. We continue to, let me zoom out a little bit here. I'll use weekly candles instead. But we had a false breakdown below that 2018 pivot, and we continue to kind of consolidate and chop within this white channel. However, today we're actually starting to break out to the upside here, up 2.3%. That's a substantial move. Something like zero coupon bonds, I might go long here on something like this for a short trade. These are very sensitive because they don't pay a coupon, they don't pay an interest. So an investor who locks in money here on this 25-year plus zero coupon ETF is essentially going to be recouping their maturity plus some premium on top of that. They'll be recouping their principal at maturity plus some premium on top of that at the end of the 25-year period. And so these are very interest rate sensitive because technically they don't pay a consistent interest or coupon payment. They simply pay an investor back at maturity plus some principal more. And so we can see here again a fantastic pivot. I even thought we were starting to see a breakdown, and I had done some analysis on this showing how we didn't secure the weekly close and we were starting to see a little bit of a hammer candle here, which could be leading to a bullish reversal. Sure enough, this week alone, zero coupon bonds are up over 5%. That's a substantial rally in this environment. The other thing I'd like to call out very quickly is the dollar. Wow, look, the dollar is up over almost 0.9% today on a day when 5 and 10-year treasury yields are down more than 6%. This is extremely bullish for the US dollar, at least in the short term here, as we break above this multi-year resistance range and break out. This is a level I've been sharing with investors on Twitter for the past several months, and particularly the bullish structure we've had for the dollar really since October when we broke above this base. I was highlighting this in real time that if we were able to clear this level, that could be bullish for the dollar. Shortly thereafter, the Fed announced officially that they would begin tapering in November of 2021, and the dollar really hasn't looked back. We've continued to produce higher highs and higher lows in this bull market, and basically the dollar is just decimating every other currency pair out in the market right now. You might be able to find certain areas where it's performing less strong than others. However, if we look at look at this breakout structure here, it's absolutely insane. But if we look at like something like the US dollar versus the Japanese yen, we also have, let me switch to monthly candles here because this is a very long-term trend. But we were able to secure the monthly close above this 2002 peak. We're starting to see a little bit of weakness. I'm really surprised to see that the yen is rallying today versus the dollar. That's very, very surprising on a day when the dollar index itself is up 0.9%. Wow, I'm actually really surprised. Let's look at something like euro dollar. We're officially starting to break down below that 2016 pivot. We're well below that 2018, 2019 low and continue to bleed weakness here after breaking below this wedge. I was outlining this fake breakout in real time and starting to note the substantial rollover that we were having in euro dollar, down over 1% today. That's a massive move in euro dollar. So again, I think what we're actually starting to see when we take all of this, actually let's do one last thing. Let's just look at the S&P 500 today, down almost 0.8%. The NASDAQ down almost 1%. The Dow Jones down 0.8% and the Russell 2000 down 0.7%. So essentially, when we look at the broader market dynamics, what we're seeing is a very clear signal, in my opinion. And to me, what this is saying is that right now, the bond market is more, and even the currency market is more preoccupied with lower growth expectations than it is with persistent inflation dynamics. Is this a signal that inflation has peaked? Perhaps. But even if inflation hasn't peaked, the broader market and bond investors are starting to officially shift into a defensive, highly risk-off investor sentiment, right? This is very indicative of where investors are putting their money, which is we're selling stocks, we're selling risk assets, and even though inflation is going to be persistent, we'd rather lock in yields that are around 3%, right? Yields got as high as 3.5% on the 2-year, the 5-year, and the 10-year, and now they're plummeting. Almost all of them are back down below 3%. So we've seen massive increase in investor demand for bonds. And so the bond market is perhaps telling us that they don't give a shit if inflation is going to be persistent. They'd rather lock in those yields with growth expectations starting to plummet. Let's also keep in mind the Atlanta Fed's GDP tracker, the GDP Now, was forecasting officially negative real GDP growth in Q2 of this year of negative 1.0%. Q1 GDP was revised lower to negative 1.6%. So officially, the markets are now anticipating an official recession and starting to shift into something that they know with some degree of certainty is going to at least pay them back principal and at least pay them back some guaranteed return and interest in the form of fixed income and bond yields. And so I kind of keep coming back to the saying that the devil you know is better than the devil you don't know. And with risk assets selling off substantially and shifting over into assets that are perceived to be risk-free, I think we're starting to see that take place. Investors are saying, you know what, it's okay if we eat the inflation risks right now. We at least know that inflation is likely going to be around the levels that they're at today, around 8%, or come back down lower towards 6% in early 2023, whatever the case is. However, we don't want to take the risk premium that we're seeing in the equity market. We'd rather lock in the yield in bonds and sit tight over the next couple of years, or at least over the next few months, right? And so I think I'll cap the video off there because this is definitely a very interesting dynamic that we're seeing in the market that investors should be aware of. Again, where bonds are pricing in and more dependent on growth expectations now than they are about inflation expectations. And even if we look at inflation expectations, 5-year break-even inflation rates are absolutely plummeting. I think I have a chart up here. This is daily break-even inflation expectations that have just come down substantially, right? And they've plummeted off the March peak and are now at their lowest level pretty much since October of 2021. We've broken below this clear support trend line that I was outlining in real time on Twitter, and we just continue to move lower here. So this could be an official shift in inflation expectations now, where again, the bond market is now forced to shift its attention over to growth. So I'll cap the video off here, but maybe the final thing I'll say is, again, this environment is not conducive for risk on, right? This is screaming to investors that we are in a risk off defensive environment. And if you're buying risk assets in this environment, I would encourage you to elongate your DCA schedule, or at least be much more patient in the frequency with which you're buying risk assets. So let's see how all this shakes out. It's been a hell of a week. This video went way longer than I was expecting, but I hope everyone learned something today, and I look forward to doing more of these in the future. Talk soon.